Hey everybody, welcome back to the channel. And today we're going to continue on the category of money management that we started in the previous video, except afterwards we dove into saying that there was three subcategories of that budgeting is what we got into. And then there's investing, and then there's realty, investing in realty. So we are going to now go into the investing portion of it, continuing from where we started from budgeting. A little note to make to address is that we are going to continue off of the budgeting amounts that we had in the last video in terms of budgeting and saving that we put aside, and we said we'd come back to those amounts of savings for later. So those savings amounts was $500 a month, $680 a month, and $1,080 a month. And just check back with the last video on how we got those numbers and how we came about that. So going into investing, we're particularly talking about, I'm just going to write a couple of things down here as we go through the video, investing. What we're particularly talking about is investing in the stock market, but not in the way that you would think of in terms of, individual stocks and day trading, all other kind of complex stuff. We're talking about investing in the stock market more in line with the way you would have a 401k at a job. Now, some jobs do this for people and some jobs do not. And in the case where if a job does it for you, in terms of setting it all up, often, they're taking that away out of like some of your check and they're putting it into your 401k for you or whatever other kind of thing you have. There's such things as 457k and all these other types of things. But generally speaking, 401k, and it's investing in various stock portfolios, packages, like a group of different stocks. And we'll kind of get into that in a little bit. But for some time, people might say, okay, like maybe I want a little more control and I want to invest on my own, not through the company in what they set up. Because a lot of times when you do a 401k, they're limiting the amount of portfolios that you can actually apply to what the company deems. And I'm not too sure on the reason why. Maybe it's because they get certain tax breaks for doing such things, because a lot of times too, you can invest in your 401k and sometimes you're able to do that before paying taxes, so pre-taxed. So that might be the reason why they end up limiting to certain types of portfolios. But in this case, whether it's, you want to do in addition to what you're already doing from a job, or say if you work a job that doesn't have a retirement plan set up for you, you have to set up your own. And a lot of people in the world have to do this, especially corporate America and whatnot. They have to do this sometime on their own. So jumping into that, this is what this type of investment is speaking on. A 401k type of plan, a type of plan where it's long term. It's not going to be, I make money overnight, but it's going to be more of like a 20-year, 30-year investment of you dumping money into it and you getting a certain amount of returns coming back around. Now, this concept is based around compound interest. And essentially what compound interest is, just a long and short of it is, if you say put $10 in an investment and it makes 10%, now it's worth $11. Now, when that money gets reinvested, you'll get say if you get additional 10% on that, it's now 10% of $11 and not 10% of $10. And it just keeps snowballing. That same concept just keeps repeating itself. So this is pretty much the concept of compound interest, and that's how all this works. And this is how you start making your money really work for you fast in this regards. So that's just kind of a little brief explanation on how that works. You don't need to really wrap your head too much around this. We're just kind of throwing this as a beginning guide just to be able to, for you to go, you know what, I'm going to take my money, I'm going to put in something. I'm not too familiar on about these kind of things, but like I can trust that I'm going to put my money in something safe. It's going to do what it has to do. It's going to compound. It's going to gain interest, and I can just sit it and forget it, as that cooking channel likes to say. So that's all we're kind of really getting into right here. So nothing too deep, but just to get you started. So we're going to go into explaining first ETFs and an index. So ETF versus an index. And pretty much they're the same thing. The only real difference is that So they're both going to be a portfolio of several stocks in them. So we'll say hypothetically for easy, setup and easy explanation, we'll say that you got 10. Most of these have like usually a couple hundred in them, but we'll say you got 10 stocks in the portfolio, and you have the ETF version of it. You have the index version. The difference, generally speaking, is the ETF, you have to buy a full share of that grouped up portfolio. So even though like it will have multiple stocks in it, there still is a share price, and that share price, will say if it's like $20, just for argument's sake, you have to buy the full $20. If you want another share of it, you have to pay $40. The index, generally speaking, it doesn't work like that. You can put down, say, if the stock is $20 for that index, that whole portfolio, you can put down $5 and you're getting a fraction of it. You don't have to buy at the full share of what that portfolio stock is. Now, just to kind of elaborate and go in a little bit details in terms of portfolios and how they work, is distributing that money of what you put into it equally. So you're getting a portion of those stocks. In this example where I said we've got 10 stocks in a portfolio, you're getting a portion of those stocks, and the weight of those stocks depend on how that portfolio is set up. And we'll go into that also when I start to bring up a couple of examples. But some of the companies that exist out there's a whole bunch of different ones. The top three that I know of is Vanguard, Fidelity, and Schwab. But from the research I've done, I feel that Vanguard and Fidelity are the two kind of really top dogs. And between those two, I think Fidelity is the one most people should go with just getting started, but I'm not, this is no kind of promotional thing. I'm just going to saying this for the ease of use. Pretty much just to give you an understanding, let me just write them down here. Vanguard, where's Fidelity? Don't mind the handwriting, I'm writing from behind the camera. So the difference is with Vanguard, there's an entry price of about $3,000 for their index, where Fidelity is no specific amount. I'm not saying you zero, but you get what I'm saying. There's no specific amount. So if I have an index of a portfolio, we'll say the S&P 500, that everyone has their own version of that. Fidelity and Vanguard has their own version, and it's pretty much the same thing. It's the top 500 stocks. And I'll go deeper into that, where how companies share the same type of setup, but they just do it slightly differently. But they both have their own version of the S&P 500. Using that as an example, Fidelity's index will, if you want to put in, say, $20, you can just put $20 in and that's it. For Vanguard, you have to start the minimum of $3,000. Now, all $3,000 of your dollars is going into your investment. It's not like there's a price to pay that absorbs like a portion of that $3,000, or that's a price for entry in terms of you got to pay Vanguard. That's all your money, but that's just required to get into the fence. So some people might view Vanguard as a little more prestigious because of this reason. The only other difference in that equation would be that the way that they weight their stocks in that S&P 500. Like I said, I'll go into that a little bit later. But essentially, that is the difference between Vanguard and Fidelity when it comes to the index. And then when it comes to the ETF, you would be buying the full share. So with Vanguard, you don't have that $3,000 minimum for ETF when it comes to buying a share for the ETF. So the ETF is going to be the same as the index, the same shares, the same weight, the same investments. So you have an S&P 500 ETF and an S&P 500 index. The only difference is that with the ETF for Vanguard, you would be able to pay whatever that share amount. We'll say hypothetically it's, maybe $100. You would be able to say, okay, I want to buy 2 shares. I'm going to pay $200. I don't have to make that $3,000, that $3,000 entry limit. But every single time you pay, you have to be exact to the amount that the share costs. Where with Vanguard, once you hit that 3,000 mark, everything after that, you can put $1, for the month. $10 for the month. It doesn't matter. Now, the way Fidelity works is their ETFs, you could put a fractional amount, so it doesn't matter. You could put like the whole share amount, or you could put a fraction. But with their index, without having a limit, you can also just put whatever amount, fractional amount. So essentially what happens is, being that Fidelity deals with fractions, you don't have that 3,000 limit for indexes. And also if you do an ETF, you don't have to do the full share amount. Like I explained, you can do partial. So essentially what happens is, and I'll just write down this here, fractional shares, essentially, the ETF and the index become the exact same thing for Fidelity. The only difference that I like to kind of really go with is the fact that the index, you're going to buy at the end of the day with the final price of what it is at the end of the day, while the ETF, you can kind of try to buy it at a better price throughout the day. And I know in that regards, the ETF is probably better, but the index will probably give you less headaches when it comes to not having to try to figure out, did I get it at the best price for that day or not? Just whatever it ends up at the market at the end of the day, that's just where you're going to get it for. And then also with the index, you can set it up, because it always goes on the price at the end of the day. You can set it up to where your bank account automatically does an auto pay for you. So I rambled a little too long on that, but just to kind of give you guys that sense of, how things work. So in this example, we're going to go with Fidelity, but you can do research on Vanguard and kind of figure things out. The purpose of this is just for you to understand how to invest in these portfolio type of stocks for your long-term investment. It's not for you picking specifically a company. So the ones that we're going to take a look at, some of the indexes we're going to take a look at this is for Fidelity, FSKAX, and that is known as the total market. And we're going to skip the their S&P 500 one, because in terms of going into it in heavy, because it's pretty much around the same ratio as the total market. But I'll write it down here just in case if you want to look it up. IX, and this is the 500 index. And the last one I'm going to throw on there that, so most of the time when I've looked at people who comment or talk about, or video channels that talk about people investing and putting together their retirement plan, these are usually the bulk of the ones they jump into, the total market or the S&P 500. And they generally do about the same average over the course of the lifespan of the index, or at least 10 years. I like to go off the 10-year mark, and they have around the same percentage. So you can go with either one, and it doesn't matter. But then I'm also going to include another one that is very tech heavy. And even though it has a greater cost, let me just jump into the cost ratio real quick, just to give you an idea. Cost ratio is so small that it's almost like you're paying like maybe somewhere between, for every $10,000 you invest, somewhere about like $4. This next one's a little more expensive, where you're probably paying like almost like for every $10,000 you invest, like, I don't know, maybe $8 or something like small like that. But the point is, I don't want to cram you with this idea of getting lost in all that, but this one makes a higher percentage, so it's worth it. But when we start doing our investment numbers, we're going to kind of split down the middle. This one's called Select Technology. We're going to just do tech for short. Portfolio. So generally speaking, the total market and the S&P 500, like I say, are within smidgets of each other in terms of their differences. And I'm just going to bring up a little image here to kind of get you to see how this is looking. So this right here is the total market. So you can see here in the 12-year mark, you're looking at a 12.4%, 12.4% average of interest that you're making. Now this year, being that we're coming from the effects of COVID, this is 2023, just coming from 2022 going into 2023, we're still looking at that backlash where things are going up, they're going down. So this is affecting the average as a whole greatly, but I'm sure once it gets back on track, I've seen that number at 14% for the 10-year mark, but right now it's going down drastically because we're still in this recovery phase. So I just want to make note of that amount real quick. as 12%. We're just going to do, because we're going to use these numbers later on when we start doing some math calculations. Now, let's see. So here shows you what's the primary things in it. So we have 20.58% is weighted in the top 10 of this. Now this has a total of 3,992 holdings. Essentially, that means that this portfolio covers that many stocks within it. But the weight of all your thing, and you can see here how it's broken down, is going into the top 10 companies. Most of it is going into the top 2, Apple and Microsoft. Of course, they're always at the top, but you see most of the weights going in there. So that way, what happens is like a rotating conveyor belt. Most of your money is going in the top ones. If for whatever reason that top one falls off, you're still heavily invested in the 9 that are below it. And you're still a little bit percentage in the ones that are all the way at the bottom. And if those ones start kind of just picking up pace, they start getting a little more weight to them, and you start, obviously you're already contributing into them. So at a certain point, it just, just flows as things just kind of replace each themselves. This is the expense ratio. You kind of like figure that out. That's the percentage, not even less than 1% of what you're paying for on the whole thing. So you could do the math, but we won't really get into that right now. Because it's so little that it's minute, you wouldn't even notice it. So don't even worry about it. When it comes to the holdings, so the S&P 500, I'm not going to go into details with that, but the percentage is the same for the most part. The items that you're investing in are the same top 10, but the only difference is instead of having 3,000 whatever, you have like about 507. So that way you get that little extra 7 just in case if one of those now go into the top 500, you had a piece of them before they, jumped big. But essentially that is how the S&P 500 works differently, and it has a little more weight in the top ones in the S&P 500. So, but generally speaking, their percentage is the same. So I'm just showing that one to you to get an idea of that. And then I'm going to bring up the other one. Let's see if I can get that up right now. I thought I already had it up and running, but right now it's giving me some issues. Okay, and we have it up, and let's see. So here you can see I've seen this one as high as 18%, but you can see here, even though it's kind of low because things are kind of getting hard, like I mentioned before, from the recession of the whole COVID and all the other stuff, you can see here that strong 16.39%. I'm just going to put that here, 16 point, I'm just going to round it up to 40.4%. And so you can see this one does a lot. It's considered higher risk, but when they say that, that's not really meaning that there's a lot of risk, because some of these companies will never go down. Now you see this one has a total of 84. Try to bring this higher up to the screen. So you can see the expense ratio is a little bit more too. It's definitely a lot higher, but it's still within the realm of that you're paying literally like just a couple of dollars on like say a $10,000 mark. Every $10,000 you're paying like just a handful of dollars. So it's really not even a lot, but because it's not even 1%. But you can see here you got 84 holdings. So you don't have a lot of holdings, but this is a tech portfolio one that is very weighted in tech, and we're in the era where everything's about tech. So essentially you have 69.59% total weight of these top 10, and you've got nearly 20% in Apple and like nearly 18% in Microsoft. So you already know that as those being your primary weight. This is one thing I'm going to say when it comes to the top 10, and this is why these things always work, even in the total market and all the rest of them, because most of the weight is in the top 10. Those top 10 companies will never go away. They may be bought out. They may be, change their name, which doesn't mean that you lose them. It just means that, if someone gets bought out and they give you a lump sum check, or, they just roll over your stocks into the new company because it's just a name change. My point I'm getting at is that they're never going to die. The day that these companies are wiped off the face of the earth is the day that the world is over. So just know that you will never have to worry about, doing it like this, that you're going to lose all your money. No, at that point you have bigger problems. The day the day Apple and Microsoft and a lot of these other big companies fade away, or even in the total stock market one, where some of the companies on here is like Chase and the bank company and a few other things like that. When those things fade away, trust me, the world is going to be coming to an end if those companies are not making it. So that's the least of your worries. So just showed you that just to kind of give you a idea of how things work, because we're going to now compile some numbers and put some things together. So first off, when it comes to the type that you're investing in, there's a Roth. There's several different types, but what we're going to get into is the Roth IRA, because I think that that's like one of the best for retirement specifically, and then your standard brokerage account. Brokerage. Look at me butchering the word. Count. And then I'll briefly explain the difference. So your standard brokerage account is just you investing in one of these portfolios, or whatever portfolio. You invest a percentage amount, and then of course whenever you end up taking money out of it, or whatever the case is, you end up having to pay taxes at some point down the line. Now the Roth IRA, you can put up to 6,000 a year, and after that, that's the max you could put in. But you can't really take that out until the time you're 60. But when you take it out at 60, you aren't taxed. So it's the long haul. So you want to provide this for your long-term retirement. You want to provide this for your more short-term retirement. And that's pretty much the basis of it. So, and we'll kind of figure out which one works for people best depending on their scenario. Now, you also have a kid's version of both of these, where you could have for your children a child's account, where you have a brokerage account for them, which they'll be able to access at 18, and then their Roth IRA one, which they won't be able to access to 60. So I'm going to tell you how that breaks down too. We're just going to jump right into it. If you're making a plan for yourself, and then depending on your age, right? If you have kids, my suggestion is you throw in that $6,000. Let's get into these compound numbers real quick, and just to give you an idea of certain things and how things work. So, and then we're going to start playing around with the numbers of what we saved in the whole budgeting from the last video. But right here is a compound calculator. Okay. And make sure you guys can see that. And what we're going to do here is I'm going to just to give you a sense of idea. Say if you have a child, newborn child, they're not even 1 year old yet. Okay. We're going to put, you could do it on a monthly basis, but I'm going to say right now, we're just going to put 6,000 as the max of the year. 0 monthly. The length of time is going to be 60 years. Estimated interest rate. So what I'm going to do now is I'm going to split the middle of these two. This is 16.4%. That's 12. We're going to do 14%. So it gives us something in the middle. I could be more conservative with it just to give you guys a sense of not this like oversight of grandeur. You know what? So we're going to do that. We're going to do that. We're going to just go with the 12%. And then you know that you might say, well, sometime that 12% could be less than that. But guess what? You could also be in that and getting way more. So we're just going to do the 12% and just kind of go with that. Just for safe measures for now, you can do this on yourself. Just go to compound interest calculator, Google it, and you'll have the same thing. You could punch in a different percentage if you want to. So we're going to go with 12% interest rate. Keep all the rest same, compound frequency annually. And so doing the math, 5,385,000. So if you put $6,000 away for your kid at 1 year old and you leave it alone till they get 60, that's what they're going to have. But the idea is that when they turn 60, that's not for them to retire. That's going to be for them giving to their kid. This is why you're going to start a Roth IRA account, and then you're also going to start a regular brokerage account. But depending on how you want to do it, you could do the Roth IRA for your kids. You could do the brokerage for yourself, or a Roth for yourself as well. But then whatever you have, you can leave that to your kids. So you don't have to also like necessarily have a brokerage for the kid and a Roth IRA and a brokerage for yourself and a Roth IRA If you're only going to do two, I would say do a Roth IRA for the kids and a brokerage for yourself, and whatever about amount of that you deem you want to leave to your kids while using some of it for yourself, you do it that way. So, and that's kind of the method we're going to stick with, just because I know sometimes people don't have a lot of options or a lot of money to kind of spread everything out all over the place. So what we're going to do is the original amounts that we came upon was, like I said before, 500, 680, and $1,080. I'll just throw those things right here just so you guys know them. This was from the last budgeting we did of a monthly amount of $2,000 a month, $3,000 a month, and $4,000 a month. And, obviously you can kind of try to make that work for you as best as possible to fit within those confines, or maybe save a little more, or maybe you can only save a little less, but whatever works for you. This just gives you a general idea. So if we're going to say that we're going to go on the basis that you have 30 years of availability to save. You might have more than that, but 30 years, we're going to say that you're maybe, 20 years old and you want to aim to retire at 50. Maybe you're 30 years old, you want to retire at 60. So on the 30-year plan, okay, on the 30-year plan, if you took $500 a month every month for 30 years, I know it seems like a lot, but I mean, this is for your future, and it allows you, when you reach that age and time goes quick, everyone knows who's living life, that, before you know it, it'll be there, and it'd be nice to know you can retire. So if you're doing that 500, and that was the someone making 2,000 a month, having that kind of budget set up, you could end up retiring so 30 years later. So if you're 20, it'd be 50. If you're 30, it'd be 60. You could be retiring with 1,460,000, we'll just round it off, 63 million. And so, you could break down that budget how you want it to be. Maybe out of that 500, a portion of it's going to the kids, maybe a portion of it's going to yourself. But keep in mind too, like I said, if you go this route of using the children's Roth IRA for your kids, you just need to put $6,000 in it, and whatever the case is whatever the case is. Maybe they are a little older already. Maybe your kid's already 10 years old. So you know what? That's fine. If you can get that $6,000 in there and you put nothing else in it, you're just contributing to your own every $500 a month, but you were able to get that $6,000 in there for them. And say if they're already 10 years old, so it's only going to be in there for 50 years. It's not as much, but guess what? At 1,734,000, you still don't have to worry about their retirement. So that's why I say, if you have kids and you feel like you can't do a whole bunch for everyone, do that plan. Get that $6,000, whether it's a tax return, whether it's something, get that $6,000 in there, leave it for the kids. Then you just keep pumping out that $500 a month for yourself for the next 30 years. And, boom, you have $1 million for yourself. And when your kids turn 60, they've got a couple million for themselves. But guess what? When they turn 60, that million is not just for them. Hopefully they've been living their life. They've been doing their thing. At that point, they would be able to get that to their kids. But keep in mind too, at 30, when you're we'll say that you're 30 years old and 30 years pass and you're 60, your kid is only gonna be 30. So that's still doing its thing. Your thing's doing its thing. And by the time you end up, reaching that, you can give a little bit to your kids. So your kids' Roth IRA will be going to your grandkids, if that makes sense. I hope I didn't confuse you with that. So anyway, I just showed that to say, don't worry about what you're doing for your kids. If you just throw that 6,000 in there, let them wait. They got so many years, so you can focus on yourself with that budget. Now, say if you are a little older, let's say you're 20 years and you're like, listen, I want to make that 60 age 60 kind of retirement range, because you have less years and you want to kind of really put into things. So this is working off the 500. So I'll just put this here, 500. So in that case, doing the math, And though you guys can do this, I'm going to just do it with you. I know it makes the video long, but you know, some people like being able to like see this firsthand. So we're going to do the 500. And then this time we're going to do for 20 years. And you're going to see it's going to be substantially less. But at the same time, too, it just gives you an idea of what to work with. Maybe you want to double down on your money, maybe whatever you want to do. So you're now ending off with 400,000, 437,000. We'll just leave it at that. The rest is a lot smaller, so we're just gonna round it off to that. So it's a significant amount less, but it lets you know that's what you would get in that crunch time of 20 years. So you can kind of play with things. You can say, okay, cool. Well, that's would be if I'm 40 years old and 20 years would put me at age 60, maybe I may have to just let that money sit for a while. And let me just throw out this concept that you could play around with later on. So let me throw it out now. So that way, when we do our figures, you can kind of play around with this concept. But essentially, let's take that amount. If you were, say, did a 30-year plan, you were a bit younger, you were either 20 or you were either 20 or you were 30, and you got that amount at 50 years old or 60. We're going to plug that into a calculator. 1463000, and they have this rule called the 4% rule. If you only take 4% out, then that rest of that interest, which we're right now working off 12%, should always replenish itself, because 4% from that leaves you with 8%. And even if the market's down one year, but because you're always putting in so much more from that percentage and taking such a small amount out, it shouldn't affect it. So that's the 4% rule. All I know is that they say it works in terms of it shouldn't affect your base amount. So say 30 years later, you're 50 or you're 60 years old, and you want to take that 4%. So we're going to times by 0.04, that's 4%, means that you would have 58,000, almost 60,000 that you're living off of your $1,463,000. You'd be living off of 60,000 and never even touching that base amount, which means that could be left for your kids later on or whatever you want to do with it later on. But the point is, you're surviving off $60,000 a year and not having to do anything after the fact. So the reason why I'm giving you that concept now is because I want you to know that that's going to apply for all these figures that we're going to do, and that understand that when you reach that retirement point, that's how you would be retired. You're living off of 4% off what's there. So let's do the same thing with, now you understand the same concept and principle, the 30-year and the 20-year, depending on how you're doing it. Let's now jump into the higher amount. So now we're looking at that 680. We're just going to do the figures for this for 30 years equals, and then we're going to do the 20 years. Sorry, my crappy arrows, they kind of look a little all over the place. But so here in the scenario, like I said, go back to the budgeting video to understand how we got here, because maybe you're able to crunch a little bit more to where you squeeze a little bit more out. But 680, and we're doing this for, we already got the 20-year plugged in, so let's just do that 20-year calculation first. I have no clue why my calculator is not. Let me just refresh the page real quick. Okay, I got things working again, so I'm just plugging it in right now behind the camera real quick. Length of time, I'm going to do the 30-year now. Now that I refreshed it, I'm just going to start at the 30. And estimated return, 12%, as we said. So this is what we're looking at here. Obviously, you see it's a bit more than what this was at 1,989,000. We'll just round that off to 90. makes it more sloppy, but there we go. So that's what you're looking at there, 1 million, almost $2 million. And then if we obviously do the 20 years, just to give you an idea, and like I said, the purpose of this is showing you with a smaller crunch time is that you could say to yourself, okay, you know what, if I do have less time, maybe I want to try to put in more money. Maybe I want to try to double down, or whatever the case is. You know, you make it work as best as you can with what the situation is. So in this case here, for the 20-year mark, we're looking at 5,900, and we'll just round it up to 95. So you can see that amount. And then we're just going to jump right into the obviously much more considerable 1,080 for the 30-year. And the 20-year. And since we already have 20 up right now, we're just going to plug in these numbers. And like I said before, you could divide this up how you feel fit. Maybe you don't want it all going into whatever type of account, but it's still the total amount that you'd be saving and investing, whether it's, you know, half of this is going to you, half of it's going to your kid, whatever the case is. So we're going to do the 20-year mark for those who are in a crunch. You're looking at just under $1 million. And that's not bad to say just in 20 years you were able to, you know, bring that up. I forgot to round, but it doesn't matter. To get to that point, you know, in a short amount of time. Sometimes people already, you know, got to a stage in their life where it's like, all right, this is where I'm at. This is what I have to do. But there's nothing wrong with that, making it work. And then now if you did for the 30 years, okay, we're going to definitely have a super substantial amount here. In 30 years, you're looking at $3 million, 3,160,000. We'll just round it off to be that. But so you could see that it's significant. And with that savings too, you're doubling the amount because you're saving more than twice as much. And this just gives you an idea of what you could do. And it's as simple as that. It's as simple as that. You take that money that you were saving, you dump it in there, wait a couple of years, and that's the simple, most safest way for you to get to that point where you'd want to get to. So that was just a little brief, you know, showing you guys on investing. I know I rambled a bit. I know the video got a little long, but pretty much gives you the long and short of it. So that way you're able to just jump right in. You can, you know, go online, look at some of these companies, whether it's Fidelity, Vanguard, whatever one works for you. Speak to one of their people if you need to. Go online, look at a couple more YouTube videos, do some research if you need a better sense of confidence with what you're doing. But just know, just all the information I gave you right now, you're able to jump right into it without a problem. It's not some kind of scam. It's not some kind of thing. People do this across the world. Everyone does this. It's not some kind of thing. A lot of people sometimes don't want the average person to know about it because they don't want them to generate generational wealth. But it really is that simple. Everyone else is doing it. So just jump into it. Don't hesitate. Just jump into it. Do the research if you got to so you can feel comfortable. But start doing that research now. Get into it right away. And we're going to leave it at that. All right, I'll see you guys in the next video.